Hello my dear students, welcome to CA Final RTP revision session. Today, myself Professor Gaurav will be taking your financial reporting RTP discussion. Now friends, there are 20 questions given by our ICI. So let us start one by one. Mini Limited, that is nothing but question number 1, which is pertaining to business combination. Mini Limited is a manufacturing entity in the textile industry. Mini Limited decide to reduce the cost of manufacturing by setting up its own power plant for their captive consumption. As per market research report, there was non-operational power plant in the nearby area. Hence, it decided to acquire that power plant, which was having capacity of 80 megawatts along with all entire labor force. This power entity was owned by another entity, Max Limited. Mini Limited approached Max Limited for acquisition of 80 megawatts power plant at the following terms. Mini Limited will seek an independent valuation for determining fair value of the 80 megawatt power plant, value of other non-current assets acquired, and non-current financial liabilities assumed is rupees 11.10 million and 32 million respectively. Consideration agreed between both the parties is at 51 million. Both the parties agreed to the terms and entered into an agreement on 1st April 20x1 with immediate effect. Due to unavoidable circumstances, valuation could not be completed by the time Max Limited finalizes its financial statements for the year ending on 31st March 20x1. Max Limited annual financial statements records the fair value of 80 megawatt power plant at 46.90 million with remaining useful life of 40 years. Max Limited also has a license to operate the power plant unrecorded in the books. As on 31st March, the fair value is 5 million. 6 months after the acquisition date, Mini Limited received independent valuation which estimates the fair value of 80 megawatt power plant at 54.90. Something like this, my dear students. CFO of Mini Limited wants you to work upon following aspects of the transactions. Determine whether the transaction should be accounted as asset acquisition or business combination. Calculate goodwill or bargain purchase due to the above acquisition. Past journal entries in the books of Mini Limited as per 103 and prepare the balance sheet. And D. Determine whether any adjustment is required in case of valuation received subsequent to acquisition. If yes, pass necessary entries in the books of Mini Limited. And the next, they have given us the balance sheet of Mini Limited, my dear students. Nothing but simple items: PP, capital work in progress, DTA, non-current assets, inventories, financial assets, investment, trade receivable, cash and cash equivalent, bank balance, other financial assets, equity and liability, equity share capital, equity component of a compound financial instrument, reserves and surplus, liabilities, non-current liabilities, they are financial liabilities, current liabilities. Okay, my dear students, very, very simple. Now, let us go what is asked in the question. First of all, they have asked us whether the transaction should be accounted as asset acquisition or business combination. Now, first of all, for that we have a guidance given in our standard, the difference between asset acquisition and business combination. It says, what is a business? Business is integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to the customer, generating investment income like dividends or their interest or any other income from ordinary activity. Now, if you look properly, there has to be an input. Input is subject to process, and when the input is subject to process, it results in output, a kind of economic benefit. Now, if you look properly, friends, here we have a power plant. This power plant is owned by another company, that is okay. Now, we agreed, and what we have done is nothing but taken their labor force also, because there was a non-operational power plant in the nearby area. The power plant is not operating as of now, but what we did was we took over the power plant. See, we are not buying Max Limited. We are not purchasing the whole entity Max Limited, but one of the power plant of Max Limited indicates business. The power plant along with labor force, power plant is nothing but the PPE, along with its labor force, of course, those who are going to work, is subject to a process, nothing but integrated set of activities, that is nothing but whatever process they have lined up to give us the output, and that output is nothing but generation of power. So can I say here in this question, there is a business combination and not asset acquisition? Yes, it is a business combination and not asset acquisition. Of course, in exam, you can't just write down one. You just have to say business is nothing but integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to the customer, generating investment income or generating other income from ordinary activity. Some kind of benefits we are going to get. Okay, so yes, it is a business combination. Then what they have asked, what's the next question, friends? B point. Calculate goodwill or gain on bargain purchase. For that, we just have to go with our step. What is the step one? Identify the acquirer. Who is the acquirer? Mini Limited is the acquirer. Then step number two. What is the date of acquisition? So can I say the date of acquisition as given in the question is 1st April 20x1. Then comes identifiable net assets. There are 8 items which I hope you remember in the class we had learned. Identifiable net assets. Now what will come in that identifiable net assets? Here it is very simple. Fair value of power plant, because that is the biggest. Now this power plant fair value, what should be the fair value on the date of acquisition? Of course, there is something known as measurement period concept, that within 12 months if there are any changes, we can write it at provisional value, and if there are any changes, those changes will be regarded as changes to business combination, provided the facts are there on the date of acquisition. So you have acquired on 1st April 20x1, and the fair value of the power plant on that date is 46.9 million. It is not only that much. If you look properly, value of non-current assets and non-current liabilities is 11.32. Fair value of non-current assets 11.10. And friends, one more point is there, very very important as far as INA is concerned, that one license was there, I read it. Here it is. Max Limited has a license to operate the power plant unrecorded in the books, but the fair value. So even though an intangible asset is not recognized by the acquiree, it will be recognized by the acquirer, provided it fulfills the definition. less fair value of non-current financial liabilities. What is the fair value of non-current financial liabilities, friends? It's given here 32 million. So I will reduce it. So what is 6.9 plus 11.1 plus 5 minus 32? That is nothing but our step 3 INA. Step 4, nothing but non-controlling interest. Can I say dash? Nothing is there because we are going to take the whole power plant. There will be no others having the control over it. Step 5 is purchase consideration. What is my purchase consideration? It's clearly given in the question. It is 51 million. So step 5, purchase consideration 51 million. Step 6, calculation of goodwill or gain on bargain purchase. We write purchase consideration plus fair value of previously held interest. Of course, this is nothing but a new business only, plus NCI. It can be at proportionate share or it can be at fair value, less INA on date of acquisition. So your INA on the date of acquisition was 31. So can I say, beta, we are getting goodwill, which is 20. And then afterwards, so this is what they have asked. Done. Past journal entries in the books of Mini. Nothing but very simple. INA account debit, that is fair value of power plant, fair value of other assets, license account debit, goodwill account debit to the purchase consideration, whatever we have paid. And then of course you can make a balance sheet also if asked. Yes, they have asked us to make a balance sheet also. So when you make a balance sheet, friends, that is very simple. I'm not going to discuss that area because what you have to do is nothing but add up all these assets and liabilities. Now the D part. Determine whether adjustment is required in case of valuation received subsequent to acquisition. Yes. Now we have received certain valuation 6 months after acquisition. It is 54.90. Now this is connected with this area. Value of non-current asset is this, but the value of power plant was 46.90. Now it is 54.90, which means the conditions, let's say the conditions with respect to the changes in this values was there on the date of acquisition. This change in value is not arising out of any new information that has arose after the date of business combination. Considering that point, we will say this provisional value was there, was 46.90. Now it is 54.90. So we are going to increase the valuation. 46, there is nothing but 54.9 minus 46.9, 8 million. We are going to increase the valuation by 8 million with respect to this, and at the same time it is going to have an effect. What? The goodwill will be adjusted. So my entry would be fair value of that PPE account debit to goodwill, and correspondingly there will also be increase on the depreciation because I would have charged depreciation based on 46.90 for 40 years. Now that 6 months depreciation is also to be adjusted. So that is the basic solution. Let us go through the solution. Yeah, so A, acquirer Mini, acquiring Max. The goodwill is already found out by journal entries to PC paid, assuming bank amount is there. And friends, what they have done is nothing but the balance sheet which is already there in this. We have to just incorporate our journal entries. We have just incorporated the journal entries. So balance sheet of Mini Limited is available. $2158, 46.90, other non-current assets, add, cash and cash equivalent got reduced, and non-current liability something got added. Now the subsequent accounting. 103 provides a measurement period window wherein if all the required information is not available on the acquisition date, the entity can do price allocation on provisional basis. During the measurement period, the acquirer shall retrospectively adjust the provisional amount recognized at the acquisition date to reflect new information obtained about facts and circumstances that existed on the acquisition date, and if known, would have affected the measurement of the amounts recognized as of that date. Any change in increase or decrease in net assets due to new information during the measure period which existed on the acquisition date will be adjusted against goodwill. Which existed, that is the important area. It means if the conditions, the facts pertaining to this new information does not exist, then we are not supposed to do anything. So accordingly, we are supposed to adjust 8 million, and also the additional depreciation will be there. So carrying amount of the goodwill will be decreased by 8 million. Depreciation expense of 1 million, 0.1 million will be charged to your expense in that period, and disclosures will be there. Journal entries, PPE to goodwill and depreciation to provision for depreciation. Okay, my friends. So that was a very simple question on business combination, but a very good question for examination purpose. Now, moving on to the next question, which is pertaining to Ind AS 21. We need to do some translation, friends. Here it is. Infotech Global Limited, a standalone entity, has a functional currency of US dollars and needs to translate its financial statements into presentation currency, that is INR. The following is the draft financial statements of Infotech Global Limited prepared in accordance with its functional currency. Property, plant, equipment, 31st March 0302, trade receivables, inventory, cash, so total assets, share capital, retained earnings, trade payables, loans, and total equity and liabilities are there. Statement of profit and loss has been given to us. Revenue in US dollars, everything, cost of sales, GP, distribution cost, admin expenses, other expenses, finance cost, profit before tax, and income tax expenses given. Retained earnings at the beginning of the year, profit for the year, dividends, and retained earnings at the end of the year, friends. Share capital was issued when the exchange rate was US dollar 1 equal to 70. Retained earnings on 1st April already translated in rupees is 4 lakhs. On 31st March X2, a cumulative gain of 4,92,000 has been recognized in foreign exchange reserve, which is due to translation of entity statements into INR in the previous year. Entity paid a dividend of US dollar 3,000 when the exchange rate was 73.5. Profit for the year 1-2 is 8,000 translated at 5,72,000, and profit for 2-3 is US dollars 14,500 translated at rupees 10,72,985. For the sake of simplicity, items of incomes and expenses are translated at weighted average monthly rate, and there has been no significant rate fluctuation during the entire year, and the business of the entity is not cyclical in nature. Relevant exchange rates have been given. On 31st March 20x2 is 73 and 20x3 is 75. Prepare financial statements of Infotech Global Limited translated from functional currency to presentation currency. Now, as per Ind AS 21, we know what that all assets and liabilities are translated using exchange rate prevailing on the date of that balance sheet. Of course, for share capital and retained earnings, whatever is the historical amount that is considered, rest everything is translated at closing rate, and any difference arising on account of translation is accumulated under foreign currency translation reserve through other comprehensive income. So my friends, very simple point here, as far as the items are concerned, 73 will be available for 20x2 and 75 will be there for 20x3. Now something they have already given. In dollars it is given. Yeah, 31st March 20x3. Now can we say this 31st March 02 everything will be at 73? Here everything will be at 75. Of course, for share capital and retained earnings we'll use the different way. The answers are already given because it will just take more time in my calculation. I'll just skip those areas. I can directly come here. Look at all these items, 73, 73 and share capital. Obviously, share capital will be always at historical rates. As far as retained earnings are concerned, friends, even retained earnings, it was given in the question on 1st April, it was 4 lakhs. So this 18,000 is 9,72,000. Now how did we get that 9,72,000 there? Yeah, I'll tell you. Opening balance of retained earnings on 1420x1 because they have given 20x1 4 lakhs plus profit for a year. Now how much is the profit made during the year? See, here it is given for 1-2 it is 5,72,000. Now you need not worry how much is the rate, what it is clearly given 5,72,000. So we have to use that only 5,72,000. So can I say I will be getting closing balance of retained earning on 31st March 20x2 9,72,000, and these 9,72,000 will become my opening balance. Plus profit will be there. Current year profit is also given 1072 985. And there are some dividends which are paid in the current year, friends. $3,000 into 73.5 in current year we have paid a dividend of 2,20,500. So 9,72,000 plus 10,72,985 minus 220,500, which gives you 18,24,485. Done? Dividends are not paid in the previous year, current year only. So my dear students, if you look properly, here 18,000, we are just writing 9,72,000. The reason is this is the amount we are considering. And then the trade payables will be at 73, loans will be at 73, foreign exchange reserve balancing over 4,92,000. Clear? Similarly, we will do it for 31st March 03, that is 75, 75, 75, 75, 1,24,87,500 minus share capital, historical and retail earnings. We have just found out 1824. Here it is 1824,485, and then the total is this much minus the loan, minus the trade payables, minus the share capital, minus the retail earning. This is nothing but my balancing figure. Remember, this is balancing figure. If you want, you can just check it out. 1,24,87,500 minus your trade payables at closing 30 lakhs minus loan 35,25,000 minus share capital 35 lakhs minus your retail earning 18,24,485, which gives me 638,015, and this was nothing but 4,92,000. Clear? So what we have done is nothing but we have translated. Foreign exchange reserve is the exchange difference resulting from translating income and expense at the average exchange rate and assets and liabilities at closing rate. Now, my dear students, if you look properly, this 4,92,000 would have been, this is cumulative balance, closing balance. 492 is the closing balance, and this is 638 is current year closing balance. So opening balance is 492, closing balance is 638. So there is a difference. It means my exchange fluctuation reserve is increasing by 638,015 minus 4,92,000, which is 1,46,015. This 1,46,015 will be shown under where? It will be shown under other comprehensive incomes. The heading will be items that will be reclassified to profit and loss account. It is a reclassifiable, not whole 492, friends. The amount that will be there will be nothing but difference between these two. I'm talking about current year profit and loss. Yeah, here it is 146,015, other common, and statement of changes in equity. See, the balance was 35, remains 35. Retained earning 972. This is what we did. Retained earning 972 minus dividend plus profit 1824 485. That is nothing but statement of changes in equity. Here 4,92,000. That is nothing but opening balance of foreign currency translation reserve, basically FCTR, and that is added here. Exchange difference transferred through OCI. And comes 638,015. Yes, so this is a basic stuff, friends. Now some of you will be thinking, sir, but they would also given us P&L. You didn't do anything of P&L. My dear students, if you look properly, don't you think this P&L was already covered here? 14,500 was already translated at 10,72,985. The translation is already given. Just 10,72,985 divided by 14,500 gives me some average rate of 73.99, and they had only given us closing rate and of previous year and closing rate of current year. So you can't say 73 plus 75 divided by 2. I will go with average. No, whatever they have done is correct. The reason being, the items of P&L are translated using the actual rate on the date of transaction. If that is not possible, then average rate can be used, provided the average approximates to the actual rate. So this is what they have done. No translation is done of profit and loss account. The reason being, they have already given the profit 14,500, which has been translated to 10,72,985. So which is nothing but somewhere around 73.99 or 74, you can say. Clear? So no need to do that. We already have this, and see here, this was given in dollars. It is already translated. Okay, my friends, so let us move on to the next question. Ind AS 27 along with 110. Entity A owns all the share capital of entity B and controls entity B. On 1st April 20x2, entity A acquired a building from entity B for rupees 600 lakhs that the group plans to use at its head office. Entity B had purchased the building from the third party on 1st April 20x1 for 525 lakhs. At that time, the building was assessed to have a useful life of 21 years and residual value of nil. On 1st April 20x2, the carrying value of the building was 500 lakhs. So 525 divided by 21 years, that gives me 25. Okay, so depreciation of 25 has been charged. The estimated useful life of the building measured on 1st April is 20 years and estimated value, residual value is nil. The method of depreciation followed is straight line. Pass entries in the books recording the above transaction in the books of entity B, entity A and group general ledger. Friends, this is similar to the questions that Airtel and Airtel communication type of question we had in our business combination and consolidation chapter when we did it together. So it is very simple. Now I'll just go through the solution. In the books of entity B, nothing but they are having this asset building account debit to bank, they purchased on 1st April, then current year depreciation, which is 25, and then they are transferring this building. Yeah, they are transferring this building for 600 lakhs to the, so bank account debit to building to profit on sale 100. Now in the books of A nothing but parent entity, that was nothing but our subsidiary entity. Building account debit to bank 600, and the current year depreciation will be nothing but 30. Now don't you think this 30 depreciation, it also includes depreciation on the profit element which has been recognized by our entity B. So the same thing will be adjusted in the group. Yeah, in the group, profit on sale of building to building 100 and building to depreciation, to eliminate the effect of intergroup transaction and to eliminate the effect of intragroup transaction. Yes, means profit of 100 has been shown in the books there. We will just remove it and we will bring the building at our cost only, that is 500. Obviously depreciation, extra depreciation on this 100 rupees has been charged. If you look properly, 100 divided by 20 because useful life for us. So this is there. This is how it will be shown. 525, 21 years, so depreciation is 25. Then now we are buying it for 620 years, depreciation is 30. Okay friends, let us now move on to the next question pertaining to consolidation. Okay friends, so we have a consolidation question. Let us move on to consolidation question, a very good and comprehensive question. Issuer Limited holds investment in Vinayak Limited. The draft balance sheet of two entities on 31st March 04 were as follows. Issuer Vinayak. Non-current assets, property, plant equipment 2620 and 1850. Investments 2150 nil. Total non-current assets, current assets, inventories, trade receivables, cash and cash equivalent. Total assets, equity and liability, equity, share capital, retained earnings, other components of equity. Okay. Next, non-current liabilities, provision, long-term borrowings, deferred taxes, total non-current liabilities, current liabilities, trade and others payables, short-term borrowings, and yes. Okay. So friends, a basic balance sheet is there. Issuer and Vinayak. Issuer holds investment in Vinayak. So this is our parent and subsidiary. Okay, now friends, some information is given. A beautiful question has been given by our ICI. On 1st April 20x1, Issuer Limited acquired 400 million shares in Vinayak Limited by means of a share exchange of 1 share in Issuer for every 2 shares acquired in Vinayak. You are acquiring 400 million shares. They are having this. Okay. So somewhere 80% stake is getting acquired. And rupees is in thousands. Issuer appointed a professional firm for conducting due diligence for acquisition of Vinayak Limited, the cost of which was 15 million. Okay. Issuer included this acquisition cost in the carrying amount of investment in Vinayak. Okay, so you have taken it as investments. Here, 21,15,000. In this it is included, something like that. Separate transaction cost, it should not be included. Issuer included this acquisition cost in the value of investments in draft balance sheet. There has been no change in the carrying amount of investment in its own balance sheet. On 1st April 20x1, the individual financial statements of Vinayak showed the following balance. Retained earnings 750 million, other components of equity 25 million. The directors of Ishwar Limited carried out a fair value exercise to measure the identifiable assets and liabilities of Vinayak on 1st April 20x1. Property, plant, equipment having carrying value of 800, land is 350, this is 450, had an estimated fair value of 1000 million, land component 400, building component 600. The building component of the property has an estimated useful life of 30 million. Plant and equipment having carrying value of 600 million, had an estimated fair value of 700 million. The estimated remaining useful life of this plant on 1st April was 4 years. None of the plant and equipment has been disposed of between 1st April to 31st March. On 1st April 20x1, the notes to financial statements of Vinayak disclosed a contingent liability. On April 20x1, the fair value of the contingent liability was 30 million. The contingencies was resolved in the year ended on 31st March and no payments were required to be made by Vinayak in respect of contingent liability. The fair value adjustments have not been reflected in the individual financial statements of Vinayak. In the consolidated financial statements, the fair value adjustments will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax to apply to temporary difference is 20%. The directors of Ishwar Limited used the proportion of net assets method when measuring non-controlling interest in Vinayak Limited in the consolidated balance sheet. Impairment review of goodwill on acquisition of Vinayak Limited. No impairment of goodwill on acquisition of Vinayak Limited was evident when the reviews were carried out on 31st March 20x2 and 31st March 20x3. On 31st March 20x4, the directors of Ishwar carried out further review and concluded that recoverable amount of net assets of Vinayak as that date was 2000 million. Vinayak is regarded as a single CGU for the purpose of measuring goodwill impairment. Okay. Provision. On 1st April 20x3, Ishwar Limited has completed a construction of a non-current asset with an estimated useful life of 20 years. The cost of construction was recognized in property, plant, equipment and depreciated appropriately. Ishwar has legal obligation to restore the site on which non-current asset is located on 31st March 2x43. The estimated cost of restoration price is 125 million. The directors of Ishwar have made a provision of 6.25 million, that is nothing but 1 by 20 into 125 million in the draft balance sheet. Okay, so here 37, Ind AS 37, some problem they have done. Measurement is not correct. An appropriate annual discount rate to relevant calculation is 6%, and at this rate, the present value of rupees 1 payable in 20 years is 31.2. Prepare consolidated balance sheet. Oh, very good comprehensive question, friends. It is going to consider Ind AS 110, that is the basic. Of course, prior to that 103, because we need to find out what is the goodwill or gain on bargain purchase. Then 110, then you need to remember the principles of Ind AS 36, impairment of asset, and that too appendix. Grossing up concept is there. Appendix C is there, and of course 37 concept of nothing but provision for decommissioning should be valued at present value. So no issues, very good question. I'll be solving it, the working notes. So first just go through the whole question, friends. Pause the video. You should be having your RTP in front of you. Read the question minutely. It will take half an hour, but please read it minutely. Make some notes there, so things will go very fast then. Don't do any audit. This is okay, this is okay. No, don't do audit. You need to solve with me. Okay, friends. So you would have done all that reading and all these things. So now let me start. We go with the our solution only. Step 1. What is step 1, friends? Identify the acquirer. Who is the acquirer here? So the acquirer is nothing but Vinayak. No, I'm sorry, who was it? Ishwar Limited. How much stake did you acquire? If you look properly, you had acquired 400 million shares. Now they've given us 5 lakh and that is rupees in 1000. So it is nothing but 500 million shares. You may just count it out if it is million. 500 million shares. So how much stake you have acquired? 400 by 500. 80% stake is acquired by issuer and the NCI is 20%. This is our step 1. Then comes step 2. When did you acquire it? Friends, we acquired the on 1st April 20x1. What is the date of consolidation? It is nothing but current year balance sheet 20x4. Okay, 31st March 4. So 1, 2, 2, 3, 3, 4. 3 years are there, friends. This will help us to make our step 3. Identifiable net assets. Now identifiable net assets, pre, post, total. The first, what was there on the date we acquired? So obviously first share capital would be there. And how much share capital was there? That is nothing but 5 lakh. Rupees is in thousands only, huh? Second, we have some retained earnings given in the question. It is 1050, but here it is, when I acquired it was 750. Which means 2 lakh. Three lakhs, sorry. The third, what is the third stuff they have given? Other components of equity. Other 25 million, and today what it is? Other component of equity 50. Okay. Now these are the things which we need to make adjustment in our financial statements, friends. Fourth point. Now what is the fourth point? That is our fair value changes. We have land whose estimated value is 1000. We have building whose value was 450, has been brought at 600. So what I'll do is fair value increase of land, fair value increase of building. Fair value increase of land. Land is 350, valued at 400, so 50 million. That is nothing but 50,000 for me. And the building, how much will be the building there for us? So if you look at your building, the building valuation was 450 million and here it is 600 million. So again, $1,50,000. So building is increasing by 1,50,000. Clear? Now friends, don't you think because of increase and decrease in the value of building and all these things, there will be additional depreciation? Now how much additional depreciation will be there on the building? On building, the additional depreciation will be based on, look here, useful life of 30 years, 1, 2, 2, 3, 3, 4. And on building, it will be additional depreciation. So 1,50,000 divided by 30 into 3, which gives me 15,000. So that will be reduced from my post figures. Then the next point. Plant and equipment having a carrying value of 600 million had an estimated fair value of 700 million. So the estimated remaining useful life of plant for first 4 years. So 600 has become 100 million. So again, fair value increase of plant and machinery. Now what is my fair value increase of plant and machinery? So fair value increase of my plant and machinery will be nothing but, friends, 600 into 700, so 100 million, 1 lakh. Rupees is in lakhs, huh? So 1 lakh. And because of this fair value increase in plant and machinery, don't you think there will be additional depreciation, friends? If you look properly, the estimated remaining useful life of plant is 4 years only. So out of which 3 years are over, additional depreciation 75,000 would be there. Ninth, we have one more point, and that is the fair value adjustments have not been reflected in individual financial statements of Vinayak. Okay, that is true. I missed out something. There is a contingent liability on 1st April 2001, and the result is there. So no payments were required. So 30 million is the fair value contingent liability. 30 million. So that is 30,000. Just check it out. 30 million. Remember, in exam we can make errors. Okay, that is 30,000 increase. That is, of course, here. Liability is increasing and resolution, or I can say decrease in contingent liability. It will be added because my P&L will be affected. Okay, now friends, what is the corresponding effect of all these items? See, these all items are already there and we are having the post items. So your land will increase by 50,000, building will increase by 1,50,000. Building will reduced by 15,000, plant and machinery will increase by 1 lakh, additional depreciation of 75,000 will be adjusted from plant and machinery, contingent liability will be increased and reduced. So this is what is going to happen. Now comes effect of deferred taxes. Now how much deferred taxes will be there? Only with respect to fair value adjustment, because the question clearly says here it is. $50,000 is the value of my increase in land plus 1,50,000 plus 1 lakh. I'm talking about pre-part. 1 lakh minus 30,000, that is 2,70,000. 2,70,000 is nothing but increase in my net assets, gives rise to deferred taxes of 20%, 54,000. It is deferred tax liability created, 54,000 DTL, and something would have reversed. So how much is reversal is happening? DTL reversed. Now the DTL reversal, how much DTL we will reverse, friends? So we'll give the effect of it. 15,000, 75,000, that is 15,000 plus 75,000, 90 minus 30, 60 into 20%. So 12,000 DTL will get reversed off. DTL reversal of 12,000. Okay, so what is my pre-share of INA? 5 lakhs plus 750 plus 25,000 plus 50,000 plus 1,50,000 plus 1 lakh minus 30,000 minus 54,000, which is nothing but 14,91,000. 14,91,000. Okay, and here post effect is 3 lakhs plus 25,000 post area minus 15 minus 75 plus 30 plus the 12,000, so 277,000. If you remember, share of parent, share of NCI into 80%, which is 221,600. I just reduced, so 55,400, and of course 1491 into 80%. 2,98,200. If you remember, we are not supposed to consider this amount. Okay, so this is how our INA is there. Step 4, non-controlling interest. Now, what is your non-controlling interest? Share in pre-INA 298,200 plus share in post-INA, you get 55,400, which is 353,600. Okay friends, then comes step 5. What is your step 5? Purchase consideration. What is the purchase consideration we have given? So if you look properly here, it was purchase consideration was this 400 million shares and 1 share in issue for every 2 shares acquired. So I acquired 400 million shares. So divided by 2. So I have issued 200 million share, each share at 7. That is nothing but 14 is there. Now this investments is there. That is at 2115. So that's not our part. 14 lakh will be our $14 lakh. Step number 6, what was that? Calculation of goodwill. Now how much goodwill is there? So we have purchase consideration, which is 14 lakh plus NCI at proportionate share of identifiable net assets on date of acquisition, that is 298,200, 2,98,200. So it gives me 16,98,200 minus the total INA on date of acquisition. So the INA on the date of acquisition, friends, is 1491, 14,91,000. So 1698,200 minus 14,91,000, which gives me 2,07,200. This is the goodwill, the amount of goodwill that will be shown. But of course, this is goodwill before impairment. You'll say, why are you talking about impairment, sir? Beta, I'm talking about impairment because here somewhere in the question, this point was there. Read this. And what we have to do is nothing but this goodwill is only parent share. So what we are supposed to do? If goodwill is of only parent share, we are supposed to gross it up, take it together and find out comparison, because they have given us Vinayak is regarded single CGU for the purpose of goodwill impairment, and the net asset is 2000 million. This is a recoverable amount. We have its total amount. What is the total Vinayak's INA today? If you look properly, 1491 was the INA on the date of acquisition, plus 2,77,000. So the INA today is 17 lakh. Of course, I'll give this effect of this 54,000 negative and reversal of DTL 12,000. 17 lakh 68,000 is the INA today of Vinayak. So 1768 plus my goodwill. Goodwill is 2 lakh. How much did we find out? 2,07,200. So if we get some amount, should that be considered? No sir, that should not be considered, because this goodwill is proportionate goodwill. We need to say this is only for 80%. How much for 100%? That goodwill you add, find out the INA, compare it with the recoverable amount, find out the impairment loss. So all these things is okay. Now I can have statement of changes in equity. In statement of changes in equity, friends, my post INA, this amount will be added. Of course, when you are adding this 221,600, generally we'll say this addition is going to happen with respect to what? Nothing but retained earning, other components, and all these things. Yeah, so this 15,000 and 75,000 will be reduced from my retained earnings. This 30,000 will be added to my retained earnings. 12,000 will also have an effect on retained earnings only. Okay, I can directly go on your solution, friends, because I found out the goodwill. I can jump on the solution. Yeah, I'll go with the working note, friends. Yeah, the first working note, they have given us 14,91,000. This is what we found out, 14,91,000. And they have also given us 1768, which is a closing balance. This is 1768. Then they have given us goodwill, which is 2,07,200. Yeah, so we got that goodwill, 2,07,200. Thereafterwards, friends, impairment. How much impairment? This is what you have to do. 1768 is the value, net assets of Vinayak today, which we have also found out. In that, I will add up the goodwill. Why, sir, you will add up the goodwill? Because 2,07,200, it indicates only 80%. We require goodwill of 100%. So 100% goodwill will take. So it comes to 27,000. And now we'll compare it with recoverable amount. That is 20 lakhs. So impairment loss is 27,000. Attributable to parent 21,600. So 21,600 will be reduced from this impairment loss. Clear? This is nothing but grossing up of goodwill. Appendix C talks about it. Yeah, this is the point. So goodwill amount will be, since non-controlling interest is measured at proportionate share of INA, the goodwill is computed entirely attributable to parent Vinayak. Accordingly, impairment will also be attributed entirely to parent Vinayak and not to NCI. 353,600. Friends, I hope you got it. Now 2865,000. What is this 2865,000? Nothing but your retained earning is there. This. On that, I am going to adjust what? Acquisition cost 15,000. Because it is not to be included in the investments. Share of provision. Now what is that share of provision? Here you had made an error. What error you have made? This point provision. You created a provision, but this provision has been made based on what? 125 million divided by 1 by 20. No. It should not be this way. 125 million should be brought based on its present value. That you are supposed to pay 125 million based on its present value. So I'll just come to the solution, friends. Provision for restoration originally required 1,25,000 into 0.0312 and 1 year winding up, because that will be affected, 1 year depreciation. So an original provision made is 6250. So what we have is nothing but C minus A minus B. 1960 is the amount of provision to be required. Fair value adjustments, deferred taxes, nothing but 42,000. Why 42,000? Look here properly. Your deferred tax is 42,000. How did you come? Sir, DTL balance is 54 minus 12. Just do this. 54 we created minus 12, which is nothing but 42,000 of deferred taxes. Rest everything is simple, friends. So share of Vinayak 2,52,000. Now how did you get this 252? Very simple. Don't worry, my friends. The share 3 lakhs plus 25,000. No, not 25,000. 3 lakh, because 25,000 should be treated separately. 3 lakh minus 15,000 minus 75,000 plus 30,000 plus 12,000. So 252, and that 252 into 80% belongs to us, and other equity, that is a component that has done differently, only 25,000 into 80%. Yeah, based on which your balance sheet has tallied. Rest all these things are very simple, friends. What was the most important was nothing but bifurcating this net assets only and finding out goodwill, and on that goodwill impairment was done. Four lakh 7,000. How did you get 4,07,000? Sir, in your question only it is given there is a deferred tax liability. So just add it. 225 plus 1,40,000, and then the deferred tax liability which got created, that is 54,000, I think so. And reverse 12,000, which gives me 4,07,000. Yeah, perfect. I repeat, friends, all these adjustments will have second effect. Land account debit, this. Then building will be added. Yeah. Then building will be reduced. Building will be reduced by 15,000. Plant and machinery will be increased by 1 lakh. It will be reduced by 75,000. Contingent liability will not be shown in the books. DTL will be created by 54,000. So DTL balance will increase and it will be reversed by 12,000. So this is all about your question. Very good and comprehensive question asked by your ICI. So third question is over, friends. Let us now move on to the next question. Question number 4. Fourth question, I'm sorry. Question number 5. In Ind AS 20, an entity opens a new factory and receives at the beginning of the year a government grant of 15,000 in respect of capital equipment costing 1 lakh. It depreciates plant and machine 20% on straight line method. Assume that there is reasonable assurance that the condition attached to the grant will be fulfilled. For year 1, pass necessary entries and show the presentation of the effects of this grant in both balance sheet and statement of profit and loss under both the methods permitted under paragraph 24. Okay, so you have received a grant of 15,000. It will be reduced from the cost of the asset. First approach. Second approach is nothing but treat as deferred grant and amortize it over the life of that particular asset. Okay. Method 1, bank account debit to government grant, so 15,000, and method number 2, and that government grant will be transferred to P&L account. Receipt of grant, transfer to P&L, depreciation charge, government grant transfer 3,000, and so on. And government grant 3,000 presentation depreciation expense, reduced from the cost, bank to government grant to plant and machinery, and then depreciation will be on reduced value. I don't think so this question will require any more discussion. Okay, Ind AS 8 is there, friends. In the financial statements for the year ended on 31st March, Y Limited reported 73,500 revenue sales, 53,500 cost of sales, 6,000 income tax expense, 20,000 retained earnings on 1st April 20x1 and 34,000 retained earnings on 31st March x2. In 2.3, after 1.2 financial statements were approved for issue, Y Limited discovered that some products in 1.2 were incorrectly included in inventories at their cost of 6,500. In 2.3, Y Limited changed its accounting policy for measurement of investment in associates after initial recognition from cost model to fair value model as per 109. This acquired its only investment in associate for 3,000 many years ago. The associate is not traded on securities exchange, that is published price quotation is not available. The fair value of the investments was determined reliably using appropriate equity valuation, that is 25,000 1 to 22 0 18,000. Okay, so changes is there. 31st March 03, the result of usage of improved lubricants, Y Limited reassessed the useful life of machine from 4 years to 7 years. Machine is depreciated on straight line method to a nil residual value. It was acquired for 6,000 on 1st April. Inventories of type manufactured by machine A were immaterial at the end of each reporting period. Y Limited accounting year ends on 31st March 03 before accounting for change in accounting policy and change in accounting estimate. Records rupees 1,04,000 revenue, sales 86,500. Cost of sale including 6,500 error in opening inventory, 1,500 depreciation and 5,250 of income tax expense. Y Limited presents the financial statement with 1 year comparative information. For simplicity, the tax effect of all items of income and expense should be assumed at 30% of the gross amount. Draft and extract show how correction of the prior period error, change in accounting policy and change in accounting estimate could be presented in statement of profit and loss and statement of changes in equity, that is retained earnings, in the financial statements of Y Limited. Oh, good one, sir. Now you may just read it once before I move on to the solution to it. Now friends, I hope you would have read it. Basically it's not that difficult, but yes, many points would have been considered. You would have reported 73,500 sales, this. Okay, now what is happening here is we reported 73,500 revenue, sales 53 cost of sales, income tax expense was 6,000 and retained earnings. Now you would have found out that there was a problem of 6,000. Let's first talk, we'll divide our discussion into these parts. That you sold some products in 1-2 were incorrectly included in inventories in 31st March to at a cost of 6,500. So what is going to happen? We need to do the changes of it. Yeah, with respect to this 6,500 both in 1-2 as well as the current year also. Yeah, so I'll just move here one by one. Restated and 2-3, that is nothing but current year. Now when I say restated, why it is 73,500? What is this 73,500? Revenue 53,500 was cost of sales. Now what should we do with respect to our cost of sales? Don't you think in this I need to add up? Why do you need to add up, friends? Because this products were sold, were included in the inventories here. So it was included in the inventories. So 60,000 is because of this. So we are left out with 13,500. I'm talking about only 1-2. Now, what is the effect of this in 2-3? In 2-3, what would have happened? Don't you think I need to make an adjustment with respect to that 6,500? Yeah, in 2-3. One lakh 4,000 is given. 86,500 is including cost of sales. Now what should we do with respect to this cost of sales? Obviously adjust it 86,500. In that we are going to adjust that 6,500 effect is to be given. 86,500. Okay, so the same thing will be adjusted. I'll just directly come upon the points which I've given, because otherwise it will become very complicated in sense. These are nothing but notes to accounts. Now let's come to our working note. 86,500 given, that is minus 6,500 correction of error, now recognized as an expense in 120, minus 900. Now this 900 is nothing but effect of change in accounting estimate. 25,500 fair value in 2-3 minus 20,000 fair value in 1-2, 5,000 the effect of applying new accounting policy. Why? We have changed this valuation, friends, here. So basically, if you look properly, each and every point has been taken care of. There are some 13 working notes. If you want, I'll just go through each of them once directly. My restated figures, 73,500. Let's begin from that only. How did we arrive at 73,500? I'll do the previous year first and then we'll come to this year. What I'll do is nothing but 1-2 year only. Say in 2001, 2002. This is restated. Now what was our revenue at that point of time? What was reported by them? 73,500. Okay, so there is no change there. 73,500. Cost of sales. Now cost of sales, if you look properly, it was 53,500 and income tax expense 6,000, that is done. But don't you think this cost of sales include an error made by us with respect to 6,500? So 53,500 plus 6,000. So I'll appropriately adjust 60,000. This is nothing but cost of sales. So I'm left out with 13,500. Now another point which is given there, you changed your accounting policy from fair value. If it acquired only investments of 3,000 many years, the associated equity not traded, the fair value was there 25,000, 20,000. So last year the balance was 18 and now it is becoming 20. And then 20, we have to take it at 25. So 18 becomes 20, change. So can I say it should be nothing but increased by 2,000 here. Fair value through profit and loss account, the change should be 2,000. And then if you look properly, 13,500 plus 2,000, which gives me 15,500. On that, tax rate is to be applied, which is 4,650. Done. And you'll be getting PAT, profit after tax, or profit for that year, 10,850. I'll go with the solution. What they have done is nothing but this point number 4, 5 and 6. This pertains to my previous year. That is nothing but 20x1 and x2. And this 1, 2, 3, it is nothing but 20x2 and 3. Okay, so you can adjust it appropriately. Rest, nothing big stuff. And you can just have a glance over everything now, because no big important issues there. And these are nothing but notes. Your increase is 5,000 because the 20 has become 25, friends. And the effect of rectification. Okay, let me move on to the next question, because this is just a theoretical part, but too much of theory. Now we move on to question number 7. On 1st April 20x1, that is pertaining to Ind AS 12, the entity is paying tax at 30% acquired a non-tax deductible office building of 1 lakh in the circumstances in which Ind AS 12 prohibits recognition of deferred tax liability associated with temporary difference of 1 lakh. The building is depreciated over 10 years at rupees 10,000 per year to a residual value of 0. The entity's financial year ends on 31st March. On 1st April 20x2, the carrying amount of the building is 90,000. It is revalued upward by 45,000 to its current market value of 1,35,000. There is no change to the estimated residual value of 0 or the useful life of the building after revaluation. Determine the carrying amount, depreciation for the year ended on 31st March 03 and defer tax thereafter till the useful life of building. Further analyze the treatment and impact of deferred tax since 31st March 20x3 till the useful life of the building. Now, my dear students, you would be aware that in Ind 12 there is an exception that no deferred tax will be recognized when there are the temporary differences arises on account of assets and liabilities recognized in a business combination, except for business combination. Then when the initial recognition does not affect the accounting profit and taxable profit. So we don't recognize deferred taxes on initial recognition unless the transaction is a business combination. That exception you had studied while doing Ind 12. Now come back here. Here it says that you acquired an asset. On initial recognition, the asset is acquired for 1 lakh. And now what is happening? No deferred taxes will be recognized, though the tax base is non-deductible. It means the tax base is 0 only. So tax base is 0, but no deferred taxes will be recognized on initial recognition, but on subsequent recognition. So on 1st April 2002, the building is 90 and it is revalued 45,000 to its market value. So now after that, don't you think we will be recognizing deferred taxes? Because on initial recognition, no deferred taxes will be recognized, but subsequent it is always there. And of course, deferred taxes, one more exception was there. In Goodwill, we don't recognize deferred taxes arising on Goodwill in case of a business combination. So here, thereafter, what we have to do is nothing but we have to find out what will be the carrying amount. Tax base is 0 only always. So whatever is the temporary difference, on that we have to create a deferred tax. So I will just move on to the solution point. Since there is no change in the estimated value, the building will be depreciated over 9 years, 15,000. Okay, so there is nothing but the amount of depreciation, because 1 lakh, first year the depreciation will be 10,000. So it is 90,000. Then I revalue 135 and 135 will be depreciated over 9 years. That is nothing but 15,000 every year. So that is reducing. So here at the end of the year, if you look properly, this is nothing but at the end of year 1, this is the value at the end of year 1, then end of year 2, 3. Initial recognition, 1 lakh, no deferred taxes. Don't say here 90,000 we are already, so we are just finding out what is the value. This revaluation, 135 is at the end of the year 1 only. So we brought it to 90 and then we reevaluate and then we say what is the effect of deferred taxes. So the gross temporary difference, the unrecognized temporary difference, recognized temporary difference arising on account of revaluation, and the deferred tax liability. So 45,000 into 30%, 13,500, and so on. As simple stuff. Yeah. No deferred taxes are recognized for timing difference on initial recognition. And the question clearly mentions a non-deductible office building, which prohibits recognition of deferred tax liability associated with the temporary difference of 1 lakh. So for 1 lakh, no deferred tax liability is to be recognized. But if you go for revaluation, but obvious, on that deferred tax liability will be there. And this is getting amortized in 10 years. Of course, DTL will be through OCI because revaluation effect is also through OCI. Okay, now let me move to the next question, question number 8, which is pertaining to 38, intangible asset. A company engaged in the provision of information technology product service incurred the following expenditure during the development phase of its software product that is to be offered to customer. The entity also purchases software from third parties for incorporating it into into its end software product offered to its customer. The company is in the process of launching it in the market for licensing to customer. The company also takes services of external professional software developer for such software development purpose. Cost incurred in relation to development of software product is as follows. Purchase price of the software, employment cost, testing cost, other cost directly related to customization, professional fees paid for external software developers, cost of training, cost of advertising in market, admin and overhead. The software was developed in 9 months and was capable of operating in the manner intended by the entity. It was brought to use on 31st March 02. The employment costs are for the period of 12 months. So employees were engaged in developing the software. Other costs related to development include an abnormal of 50,000. So of course friends, what will be the cost that will be capitalized? This is what the question is asking us. How much cost we will capitalize it? Now friends, if I look properly here, the whole 600 will be capitalized. But as far as employment cost is concerned, here it says employees were engaged only for developing it for 9 months. So if the employees are engaged for only 9 months, it means not whole 1200 but only 900 will form part of our cost. Likewise, testing cost, the whole 1800. Other cost, there is note 2 which says that 50,000 is abnormal amount. So 50,000 is abnormal, so we'll be including only 400. Professional fees, the whole 220 will be there. Cost of training the staff, this is not necessary, so it will not be included. Same way, the cost of advertising not necessary. General and admin overheads not necessary. So the cost of our software will be nothing but 600 plus 900 plus 1800 plus 400 plus 220. The cost of software that should be included should be 3920. Yeah, a very simple question. 600, 900. I hope it's done, my friends. Okay. I'll move on to the next part. That is nothing but our 109. It's a very small area. On 1st April, the bank provides an entity with 4-year loan of 5,000 on normal market terms, including charging interest at a fixed rate of 8% per year. Interest is payable at end of each year. The figure 8% is market rate for similar 4-year interest loan with interest paid annually in arrears. Transaction cost of rupees 100 is incurred on originating the loan. Effective interest rate is 8.612. In 1-2, the entity experienced financial difficulties. The bank agreed to modify the terms of the loan. Under the new terms, the interest rate for 2, 3 and 4, 5 will be reduced from 8% to 5%. The entity paid a bank fee of 50 for paperwork relating to modification. Analyze whether the modification of the loan terms constitutes to extinguishment of original financial liability or not. Is it an extinguishment? Okay. Now friends, if this modification which is happening, we have to compare the present value of cash flow under the new terms discounted using the original interest rate, and that too include that fee also is there. If the difference between these two cash flows, that is nothing but whatever is the cash flow which is already there, and we should find out what is the fair value of the amortized cost of the loan on the date of modification. In the revised cash flow, if we find out, if the difference is more than 10%, then we can say that this is nothing but extinguishment of a liability. Yeah, so this the working we need to do. First we need to find out what is the fair value of the loan on the date of modification, that is 31st March X2. Okay. Since the interest was set at market rate on 1st April, entity initial recognized will measure the loan at transaction price less transaction cost of 4,900. Yeah, 5,100 is originating. So 8.612. Yeah. So it comes to 4,900, this cash outflow. Okay, 2,334, and this is nothing but the original amortization table. On 31st March 20x2, the value remaining cash flow of original financial liability is 4,921 discounted at original effective interest rate of 8,612. There is nothing but 4,921 here, x2. Now, what is the present value of the cash flow under the new terms? Now, under the new terms, what you are going to pay? You are going to pay 250, 250 and 5250. Yes. So, under the new terms, the present value is 4537. Now, I have to compare this to 4537. Including the fee of 50, the present value is 4587. And 4921, which is this amount, and 4587, it is 334. 334.74 divided by 4921.99. Friends, how much percent do you get? If it is more than 10%, then this modification will be regarded as extinguishment of original liability and the conveying of a new liability. The difference is 6.8%. The entity applies its judgment to decide whether the terms of the instruments exchange are substantially different. Since the difference of discounted present value of cash flows under new terms, including any fee, is less than 10%, the remaining cash flow, this modification should not be considered as a substance. Therefore, modification would not be accounted as extinguishment of original finance liability. Okay, now I move on to the 10th question. That is nothing but cash flow statement. One of the subsidiaries of Buildwell Limited submitted to Central Finance its summarized statement of P&L, net sales, cost of sales, depreciation, salaries, wages, operating provision, operating profit, non-recurring income, retained earnings, and dividend is declared, profit and loss balance. The assets have been given. The original equipment is sold for 720. My dear students, I don't think so this will require any more discussion. You're supposed to make a cash flow statement. Oh, it's very simple for you. You can just have an idea with respect to what indirect method only we can make. Land, there is a change in value. Building, there is a change in value. There is some sale which is happening. So it's all formality of preparing the accounts and all those things. I'll just go through them. Any working note is there. So building and equipment, purchase, depreciation will just give you an idea. Provision for tax, the amount that has been paid here. Okay, so nothing big stuff here. Net profit before tax is an extraordinary item. ₹8,720 plus 880. Dividends and 880. Okay, that has been added, both of things. Which is nothing but 16 lakhs. What we have to do is nothing but we have to only consider this. And what is the profit? That is nothing but profit before tax. Then add back depreciation and changes in inventories and all these things, assets, liabilities, cash generated from operation. From that we deduct income tax, purchase of land, sale of land. Okay, so this is something what you have been doing in Inter also, the same stuff. Okay friends, so I don't think so we should invest more time on this because not that much important stuff is available here for revision. Now let me move on to the next Ind AS, that is Ind AS 105. Company X has identified one of its division, disposal group, to be sold to a prospective buyer, and the board has approved the plan to sell the division on 30th September 20x1. The sale is expected to complete after 1 year, but it still qualifies to be held as sale under Appendix B of 105. Cost to sell the division is estimated 10 crores to be incurred in March 20x3. The fair value of the division is 400 crores on 30th September and 31st March 02. Carrying value is 500 crore. How shall such division or disposal group be measured under Ind AS 105 on the following reporting dates? 30th September and 31st March. Consider the discounting factor of 10% for year 1, 909, and for 1.5 years to be 0.867. This is what we are given the information. Now as per our Ind AS 105, if the disposal is going to happen after 12 months, then don't you think we consider discounting factors? Yeah, so let us start with the solution. We'll just check it out. So we have some 400 crores and this is 10 crores. On 10 crores we'll apply this 0.867 because the disposal is going to happen somewhere in March 20x3, so 1.5 year, and 31st March our fair value is 500 crores minus the cost of disposal is 10 crore only, and that for that I will be using the discounting factor 909. Nothing big in this. 408. Yeah. So my division which was shown at 391 and 390. It will be measured at fair value, and this change in this finance cost from 8.67 to 9.09, that is nothing but finance charges only. Huh? This is nothing but unwinding of discount, you can say. Nothing big in this again. Okay friends, we move on to question number 12. In days 2, A Limited began operation in 1-2. In 1-2, it incurred the following expenditure on purchasing the raw material for its product. Purchase price 30,000, import duty 8,000, refundable tax 1,000, freight cost for bringing the goods from supplier to factory showroom 3,000, cost of unloading the materials into storeroom for raw materials 20, and packaging 2,000. On 31st March, A Limited received 530 volume rebate from a supplier for purchasing more than 15,000 from the supplier during the year. A Limited incurred additional cost production run 5,000, salary of factory supervisor 3,000, depreciation on factory building, consumables, depreciation on vehicle, factory electric usage, factory and depreciation of the entity vehicle used by the factory supervisor 200. Incur following admin expenses. Oh, very good question. Of the admin expense, 20% is attributable for administering the factory. Remaining expenses are in equal proportion to sales and other non-production, example finance. In 1-2, incur selling expenses. Okay, this do not form part of it. Pass necessary entry to record the cost of inventory. First of all, we have to find out what is the cost of raw material. Cost of raw material, that is nothing but 30,000 plus 8,000. Freight cost of bringing 3,000. ₹20 will also be added here. Yeah. So friends, if you look properly, 42,490. Now why did I get that amount 42,490? Very simple friends. I just added up all these things. This plus this. Refundable purchases not to be added. So 30,000 plus your 8,000 plus 3,000 plus 20 plus packaging 2,000, and that volume rebate is there 530, which gives me 42,490. Okay. Then what all expenses will be there? This will be nothing but inventory to cash bank. Thereafterwards, raw material we is purchase, and then what we will do? Salary to this. So 5,000 will be there. Then salary of factory supervisor of 3,000 will also be there. Depreciation on factory equipment. Yes, friends, that will be there. Consumable used in this will also be forming part of it. Depreciation on vehicle used for transportation. Yes, it will also fund. Factory usage, nothing but factory electric usage, factory rental. Depreciation on the entity's vehicle used by factory supervisor. Okay, this will also be there. Now see, this is admin expenses. Which admin expenses will be added? Yeah, 20% is attributable to what? Nothing but our administrating the factory. So whatever is your admin expense, of that 20% will be added. Similarly, what about selling expenses? Not, it will not form part of it. So 500 into 20%, year 150 into 20%, and 3050 into 20%. This all things will be added. So friends, everything, this will not be there. $42,490. Yes, we had this word. Working note number 1. 30,000. 8,000, 3,020 packaging minus, okay, 42. Refundable tax. Now see, the direct labor 5,000 is there. Direct labor 5,000, salary of supervisor 3,000, depreciation 600, 400, 200, 600, 300, 200, and this. Yeah, all those things are coming here. Factory electric, factory management, factory rental, other cost of administrating, this, consumables, cost of conversion 11,440. Oh, done. Good question as far as Index 2 is concerned. Now friends, moving on to the next question. Besides manufacturing plant, this is related to Index 40 and 16, investment property. A Limited has various assets not used for operational activities. Example, freehold land, township in different locations, excess of office space rented to ABC. Also, A Limited has some land which are kept vacant as per government regulation, which require that specified area around the plant should be kept vacant. The details: A Limited's office building, registered office in Delhi, is a 15-story, of which only 3 floors are occupied. Remaining floors are given on rent to other companies. These agreements are usually for 3 years. According to A Limited, such excess office space will continue to be let out on lease to external parties and have no plans to occupy it, at least in future. Flats in townships are located in location 1. As regard to township in location 1, there is approximately 2,000 flats in the said township. It was built primarily for A Limited employees, hence approximately 80% of the flats allotted to the employees, and remaining flats are either kept vacant or given on rent to external parties. A lease agreement is signed between A Limited and individual party for every 12 months, being 1st April to 31st March. The lease entered is a cancelable lease at the option of any of the parties. Also, besides monthly rent, additional charges are levied by A Limited on account of electricity, water, cable connection, etc. A Limited has no intention of selling such excess flats or allotting to its employee. Flats in township located there are 1,000 flats. 400 flats are given to employees. 350 are given rent to central governments for accommodating of their employees. Average lease period being 12 months with cancelable clause. 250 flats are kept vacant. Hostel located in location 160 rooms in hostel have been let out to G Limited to give accommodation to their personnel. Lease agreement is prepared for every 11 months and renewed thereafter. Besides the monthly rent, some charges are levied towards water and electricity and other cable connection. Land in location 1. Purchase a plot of land in outskirts of major city. The area has mainly low cost public housing and very limited public transport. The government has planned to develop the area as industrial park and as land is expected to greatly appreciate. A has not decided what to do with this property. Again, land in location 1. Portion of land has been leased out to C for its manufacturing operation. Land has been given on lease rental of 10 lakhs per annum with a lease term of 25 years. Land in location 2. A portion of land has been given on rent to D, which has constructed a petrol pump. It has been leased for a period of 40 years, renewed further for 40 years. Determine the classification of properties which are not held for operational purposes with suitable reasoning in the financial statements. Friends, nothing but India's 40 has listed out that reasons what are we supposed to do and all those things, that this property land with an undetermined future use and all those things. So just let's check it out one by one, each and every item. Now friends, as far as the first part is concerned, 3 floors you are using. The remaining 12 floors, if it can be sold out separately or leased out on a finance lease, then that will be considered as investment property. As far as this is concerned, flat in the township, what is there with regards to flat kept vacant? You have to vacant flats only. Other flats which has been given to employees is your PPE. What is not given to employees, have to evaluate whether it will be given to employees or will not be given to, it will be rented out, then it will be obviously considered as investment properties. So now see the assets for which there is no clarity given, we can have both the answers. I just come on this excess portion. 3 floors are occupied, such excess office space constructed according such excess will let out. Office space given on rent, although in same building, is separately identifiable from another occupied, hence will be sold if required, hence the excess space will be investment property. Now as far as flats given on rent, but the monthly charges in such a general or significant, flat is investment property. Whether it will qualify for rentals or will be allotted in future. In case they are held for rental, it will be investment. If they are held for allotment in future, it will be form part of property, plant, equipment. 350 flats are there. Management intends to let out these flats, so it will be investment property. Hostel rooms located in location 1. It is an investment property because it is let out. Land in location 1, can I say it is an undetermined future use? So land held for undetermined future use is an investment property. Again, land in location 1 and 2, both are investment properties only. Now let us move on to the next index, that is 111. Entities A and B establish 50-50 joint operation in form of separate legal entity J, whereby each operator has 50% ownership interest and takes 50% of the output. On formation, the joint operation, entity A contributes a property fair value of 110 lakhs and intangible assets with a fair value of 10 lakhs, whereas entity B contributes equipment with a fair value of 120 lakhs. The carrying amount of assets contributed by entities A and B are 180 lakh respectively. What will be the amount of any gain or loss to be recognized by entity A and B in the separate financial statements as well as consolidated financial statements? Now friends, I will find out the gain in the books of entity A. Of course, you can do it for entity B. Now, what is the gain made by entity A here? If you look properly, entity A has given its own value, asset whose cost is 100 lakhs. And now the fair value of entity B is 120, in which you have worth of how much? Fair value of asset contributed by B. Now you also have worth of it. The fair value of the asset is 120 lakhs into 50%. That is nothing but 60. And less share of entity B in asset contributed by entity A. So I give an asset of 100 in which they have a share of 50%. So 50. So my gain is nothing but 10. Simple. And same thing you can do for B also. States that if an entity enters into a transaction with joint operation in which the joint operators such as sale or contribution asset is conducting the transaction with respect to joint operation, the joint operators shall recognize gain or loss resulting from transaction only to the extent of others party interest in the joint operation. A share in fair value 60 less asset contributed by entity A in the joint operation, and share of the other party 50 10. Alternatively, nothing but share acquired in fair value of net assets of joint operation. The fair value of the assets 110 plus 10 plus 120, that is 240. Your asset contributed 100. Unrealized portion of the gain on asset contributed, which is 10 because 120 is total fair value. So my gain is 10. The same thing applies. This is an alternative way, nothing big. Now, let's move on to question number 15. On 31st March 20X1, Jackson Limited purchased %80 of equity of Kaplan for 190 million. The fair value of net assets of Kaplan that were included in consolidated balance sheet of Jackson on 31st March were measured at 200 million, their fair values at that date. It is the group policy to value NCI in subsidiaries on the acquisition date at its proportionate share of fair value of the subsidiaries' identifiable net assets. On 31st March 04, Jackson carried out an annual review of goodwill on consolidation of Kaplan for evidence of impairment. No impairment had been evident when the reviews were carried out on 31st March 02 and 03. The review involved allocating the assets of Kaplan into 3 CGU and computing value of each unit. The carrying value of individual units before any impairment adjustment is this, and the value in use has been given. It was not possible to meaningfully allocate the goodwill on consolidation to the individual CGU, but all other net assets of Kaplan Limited are allocated in the table shown below. The intangible assets of Kaplan have no ascertainable market value, but all the current assets have a market value that is at least to their carrying value. The value in use of Kaplan Limited as a single CGU on 31st March 04 is 350 million. Recommend the treatment or impairment of goodwill. If you can recall, we had divided goodwill is relatable but not allocable, and goodwill is relatable and allocable. Relatable, in one case it is allocable, in other case it was not allocable. Okay friends, so let us do this question. So friends, here this is the most vital area which will help us out, that you cannot allocate it. If you cannot allocate it, so what will you do? You will bring the whole assets, CGU of all the Kaplan together and then add the goodwill. So what is the amount of goodwill that we have to calculate here? You have acquired 80% of Kaplan for 190 million. First point 80% means somewhere or the other you should also get the amount that we need to apply the appendix grossing up of goodwill, because here it is at proportionate share. So what will be the amount of goodwill? First let us calculate calculation of goodwill. The purchase consideration paid by you 190 million plus the NCI on the date of acquisition. The fair value is 200 million. So 200 into 20%, which is nothing but 40. 190 plus 40, that is 230. Less INA on the date of acquisition. The INA is nothing but 200 million. So 200. So goodwill is 30 million. Now, my dear students, don't you think this 30 million is the goodwill of the whole entity, but only Kaplan share, not the NCI share. So now when we are going to test for impairment, we'll just gross it up. So 30 is 80%. So can I say 100% goodwill will be nothing but 37.5. I can now directly go, before this goodwill cannot be allocated on those three CGUs which they have given, unit A, B, C. So first we will test those CGUs for impairment, because if you read the question, the CGU is showing impairment. This C, cost here is 170, 180, no impairment. 90, 66, yes, impairment is there. So impairment is how much? 34 is the impairment, 66, 76, 86, yeah. 24 is the impairment, but this 24 impairment will be charged against what? It will be charged between intangible assets and PP only, not current asset, because current assets are not covered by this standard only. They are covered by those relevant standard. It may be inventory, it may be financial asset. And one more point, it says that they have no asset, but all current assets have market value that is at least equal to their carrying value. It means there is no change to be done in this. So 90 minus 66, friends, I will be getting 24. This 24 will go between these two. 4 will be in intangible. Ratio of this carrying amount 1:5. Okay, so let me just move on. The goodwill on consolidation will be 30 million. Yes, 30 million. We got it. Unit A, B, C. So however, unit B has less than carrying amount. So we'll charge impairment loss. So now revised value will be 66. Unit A 170, this will be 66 and this will be 100. And that goodwill 37.50. How did you get 37.50? Friends, if you remember, this 30 is 80%. We need to gross up, because what they have given us recoverable amount of Kaplan Limited as a whole, which includes even NCI. So what is 100%? 37.5 you'll get. $373, and what is the value of Kaplan Limited? 350. So 23, obviously it will be against goodwill only 14. Yeah, so 23.50 is the impairment loss, out of which our amount is only 80%, that will be reduced. So goodwill which is shown in our books is 30 million. 23.5 into 80%, my dear students, 18.8 will be reduced from the 30 million. Your revised goodwill will be 11.2 in the books. Okay, simple. So nothing big. Let us move on to next question, question number 16. Pertaining to employee benefits. Arunachalam operates a defined retirement benefits plan for its current and former employees. Given the large size of the company, it engaged firm of actuaries for advice on contribution levels and overall liabilities. On 1st April 20x1, the actual valuation of present value of defined benefit obligation is 15. Same date fair value of the asset is 13. The annual government bond is 5%. During the year, Arunachal made contribution 1.75 to the plan, paid out benefits 1.05. Assume both these payments are made on 31st March. Actual firm estimated that the current service cost is 1.55. You have changed the amendment, and that is referred as 37.5. During the year, ended on 31st March 02. Arunachal was in negotiation with employees representative regarding planned redundancies. These negotiations were completed shortly before the year at the end and redundancy package were agreed. The impact was to reduce the defined benefit obligation by 2 crores. You made a payment of 1.875 for this redundancies. There is a gain happening. Gain will be there. Present value of defined benefit obligation was 17 and this is 14. How these things will be accounted in the books? Okay. One by one we can just take care of it. Now what is the opening balance of your defined benefit obligation? If you look properly, the defined benefit obligation is 15. The asset is 13. So nothing but 2 crores will be there. 200 lakhs or 2 crores. On that there will be an interest cost. So interest cost will be nothing but based on net defined benefit liability, whatever is the net defined benefit liability. Two crores on 5%, nothing but 10 lakhs will be there. But of course, we have to show it separately. You can show it as a gross also and net also. So interest cost will be nothing but 15 minus 13, 2 crores into 5%, 10 lakhs. You made contribution to the plan, so it will be added. Benefits paid out is nothing but liability will get reduced also and assets will also get reduced. And 1.75 will be increase in plan assets, so plan assets to bank. Your current service for cost will be debited to P&L, so current service cost account debit to defined benefit liability. You have amended the plan, so past service cost to defined benefit liability 37.5, and here it will be nothing but you have made a payment also, so your plan assets will also get reduced by 1.875. Your defined benefit obligation will get reduced by 2 crore, and there will be difference of 2 crore minus 1.875, which gives me 0.125, that is gain on curtailment. And whatever is the difference, closing balance, that we have to look whether it is an actual gain and loss on plan assets as well as on defined benefit obligation. We have to consider the actual gains and loss on plan assets and defined benefit obligation. Clear, friends? I can just directly come on this. Current service cost, past service cost, gain on settlement 0.125, that is 12.50, and interest is 10. Now how this actual gain and loss came? We'll make a defined benefit obligation account, and balancing figure is nothing but actual loss here. And same way plan assets, this. Oh, this is the next question, I'm sorry. Yeah, friends, not that big. Yeah, this is just an alternative part. I would just suggest look at this. And remember, whenever payments are made, we will redeem our plan assets. Okay, now let us move on to the next question. On 1st April, entity enters into contract with entity Y to sell mobile chargers for 100 per charger. As per the terms of the contract, entity Y purchases more than 1000 chargers till March 20x2. The price per charger will be retrospectively reduced to 90 per unit. Till September 20x1, entity sold 95 chargers to Y. X estimates that entity Y's purchase will not exceed 1000 chargers. In October X1, entity Y acquires another entity C for October X1 to December. Entity sells another 600 chargers. Due to this development, entity X estimates that purchase price of Y will exceed 1000 chargers threshold for the period. It is therefore required to retrospectively reduce the price of charger to 90. Analyze the above scenario in light of 115. Nothing but there is a retrospective amendment. So can I say my transaction price will be revised retrospectively? Very simple. The same question is there in our textbook also, my dear students. Now, my dear friends, can I say we have sold how many chargers? 600 chargers. So what should be the revenue for these 600 chargers? It should be the revised transaction price. which is 90. So 600 into 90, 54,000. And from that, we need to do a cumulative catch up. No, this is additional, na? Okay, we have already sold 95. So I'll do it for 695. Just wait, my friends. This is not total, but 695. So 695 chargers, the price will be 90 rupees. So 62,550 less revenue already recognized. With respect to 95 charges, we have recognized a revenue of 100. So in current quarter, we need to recognize revenue of 53,050. Okay. So this is the revenue I will recognize in current quarter. This is already recognized till date. This is the cumulative. Let us go through the solution given by our ICI. Oh, good theoretical part is given. You may just go through the theory. Very good theory. Oh, the answer is here, 53,050. Both the answers are same, don't worry, here it is. Yeah, what I have done is I have done cumulative. Whatever module has done is nothing but they have taken 600 and then whatever charger they have sold, that price they have retroactively adjusted. 95 into 10, that is 950. Nothing big in that. Question number 18. You need to write theory. You will say, sir, should we write theory? It all depends. See, if this type of question is asked only for 4 to 5 marks, you can directly write down this answer in a small theory. The theory given by the module is very exhaustive theory. M. Chinna Swamy and Brothers is a company engaged in growing and maintaining coconut palms and selling their output in various forms. The company has a farmland of 2 lakh coconut palms in the coastal area of Karnataka near Mangaluru. The fair value of each coconut palm is derived based on average realizable price of 30 per nut. Each coconut plant grows 80 nuts per annum on average basis. Each coconut plant can generate a revenue for as long as 80 years. And the current palms are only 20 years old. The management thinks that considering the risk factors in the business, valuation of each palm can be considered 5 times of annual revenue. During August, Ooty Hotel Association chairman and his team visited the corporate office of the company in Mangaluru. The deal was to supply tender coconuts to Ooty hotels at an agreed price. The agreement came into effect of 1st September, where company shall reserve 15,000 of coconut palms out of 2 lakh for OHA and will charge concessional rate of 50 only per nut supplied to OHA. OHA will in turn supply the tender coconuts to each Ooty hotel at the same price. The contract price is applicable irrespective of the ownership of palm trees. It is not an entity specific restriction. All the tender coconuts of this 15,000 were used by OHA irrespective of agreement being effective. What will be the valuation of 2 lakh total coconut palms in the company's farm on the quarter ending on 30th September? Now for that valuation, it's nothing but biological asset for us. How should we go for valuing it? Now this Ooty Association has taken how many? 15,000 only. So 15,000 divided by, we have how many? 2 lakhs. It gives me 7.5%. It represents just a 7.5%. of the total number of palms in the farm. The contract price can't be considered for fair valuation of the entire inventory of bearer plants. Okay, so now what should be the value of my bearer plants? Nothing but, as far as 15,000 palms are concerned, each palm is going to 80 nuts, and that we are going to sell it to this Uti association. For what price? It was 15 rupees. And how many times? So 5 times. ₹90 crores. As far as remaining 1,85,000 palms are concerned, that is also 80 nuts. That I will be selling it at 30 rupees in the market into 5. $1,85,000 into 30 into 5. Oh, friends, I made an error here. It's not 90, it's 9 here. This comes to 222 crore. Yeah, so 231. I'll check it again here. So 15,000 into 80 into 15 into 5. That is 9 crore. Yes. I wrote 90 crore. It is 9 crore. Kindly rectified. So 231 crore is the worth of your coconut palms. Entity often enter into contract sell biological assets. Contract price are not necessarily relevant in measuring fair value because fair value reflects current market condition. And buyers and sellers would enter. As a result, the fair value of biological asset or aggregate produce is not adjusted. You represent only 7.5. Hence, contract price can be considered for fair valuation for entire inventory of bearer plants. Only with respect to whatever plants I have, I will go for 15,000 palm, the contract price, and remaining I will take the market price, which is 231 crore. Okay, done. Let us now move on to the next Ind AS. No, I think it's not of 19, but let us see. On 1st January 20x2, directors of Johansen Limited decided to terminate the production at one of the company's division. The decision was publicly announced on 31st Jan. The activities of the division were gradually reduced from 1st April 02 and closure is expected to be completed by 30th September 2002. On 31st Jan, the directors prepared the following estimates. Redundancy costs were initially estimated at 2 millions. Further expenditure of 8 lakhs will be necessary to retrain the employees who will be affected by closure but remained with Johansen Limited. Different retraining will latest estimate that redundancy cost is 1.9 with retraining 850. If you remember restructuring under 37, we will only consider the cost which are for that particular stuff. This retraining cost will not form part of my provision. Yes. Basically, this is not getting related to 19. Somewhere 37 is getting united. But somewhere even that, I can just say that 19 gets related to certain extent because we are going to make termination payments. And plant and equipment having expected carrying value of 31st March 02, 8 million will have recoverable amount of 1.5 million. So this will lead to 6.5. Division is under contract to supply goods to customer next 3 years. It will be necessary to pay a compensation of 6 lakhs to this customer. The compensation will be paid was 550. So again, we need to make a provision for it. The division will make operating losses of 3 lakh per month in the first 3 months. Okay, no issues. Okay, nothing. Division operates from lease or premise. Lease is non-cancelable. And annual lease rental is 1.5. So we need to create provision for this. Yeah, nothing but onerous contract is there. Following the closure of division, Johnson would be able to sublet the property from 1st October. Johnson could not expect to receive renter of 3 lakhs for 6 months from 1st October 31st March, annual renter 5 lakhs. Okay. All renters will be received in arrears. Okay. Any discounting calculation should be performed using discounting rate. Now, nothing but friends, redundancy cost is there. So we have to create a provision for it. For all these things. Here, I will create a provision for how much? 1.9 million. The retraining cost of 8 lakh 50. Okay, I'll just go through the solution fast. Okay. So retraining cost will never form part of it. This is what I spoke. Impairment of equipment 6.5 million. Impairment of 6.5 million will be there. Your breach of contract 0.55. Future operating losses are never recognized, so nothing. Now this is an onerous contract, expected cost of fulfilling. So we have to make provision at lower of the expected net cost of fulfilling the contract and the cost of early termination. Early termination not available. The net cost of fulfilling the contract is 4.51 million. 1.5 into 4.32 minus 0.3 into 0.95, and this. Nothing but those discounting factors have been considered, friends. Nothing to worry about. Okay. So that is just a working part. Now I move on to the last question, that is 116. Entity X Limited is a utility company, enters into contract for 20 years with Entity Y, a power company, to purchase all the electricity produced by a new solar power station. The solar power station is explicitly specified in the contract and Entity Y has no substitution rights. Y owns the solar power station and will receive tax credit relating to construction and ownership of the solar power station. Entity X will receive renewable energy credits that will accrue. Entity X has right to obtain substantially all the economic benefits of the solar during the period. Means, does the arrangement contain a lease? Answer is yes, the arrangement contains a lease. Yeah, you may just go through it. You have right to obtain substantially all the economic benefits from use of solar power station. Okay. So friends, so this is the end of my RTP discussion with you. Thank you very much.